Whenever you get into the physical arena, it requires something. It requires storage, it requires transportation. Paper is so much easier and cheaper, and it's so much easier to leverage. And that works until it doesn't. And I make this point because that whole paper derivative gold market and silver as well is going to unravel. You want to be holding the physical when it does, because that's when they're going to ultimately have to reset and restructure this entire system.
In times of recession, investors should tread carefully but remain vigilant in monitoring the market landscape for opportunities to purchase high-quality assets at discount prices. These are challenging environments, but they also coincide with the best opportunities. Gold and silver have been a prized commodity for centuries. Throughout recorded history, gold has been used as currency and a symbol of wealth and power. Investors consider gold to be one of the safest investments as it recovers its value quickly in the event of an economic downturn. Their price often follows economic or market fluctuations. When investor confidence takes a hit, gold prices often rise as nervous investors look for a safe place to put withdrawn cash. Gold is also a safe haven in times of inflation because it holds its value much better than currency-backed assets, which can rise in price but lose value. In today's video, we'll tell you why Lynette Zang believes gold and silver are the best assets to take full advantage of the recession. But before we get into the video, make sure you subscribe to our channel and press that bell icon to never miss an update. Historically, the value of gold sometimes declines initially at the start of a recession. However, it's realistic to expect that, in most cases, it will recover and increase in value during the recession. History indicates that this point can be a fantastic buying opportunity. Central banks have admitted to manipulating the price of gold because they want you to stay away. Every time you enter the physical arena, it requires something. It requires storage. It requires transportation. They earn much less money, $30 million a year on average. Paper is much easier and cheaper, and it's much easier to operate, and it works until it stops working. Because this whole paper-derived gold and silver market is going to crash, you want to keep the physical when you do it, because that's when they will eventually have to reset and restructure the entire system. So you have hedge funds and so forth, but you also have these central banks that trade gold for their reserves, that trade gold to manipulate the price. Although many global central banks are hoarding gold now, but remember what JP Morgan said, only gold is money, everything else is credit. If you own a GLD or SLV unit, you only have units in a trust, and these things were designed to follow the spot market, which is so easy to manipulate. If you currently have credit card debt or in debt for an upcoming major purchase, interest rates are high. They're going up, and they can get out of control pretty quickly because if you make your minimums, chances are you won't, not even paying interest on any credit cards. And now that interest, just like our government, doesn't pay all the interest on all the debt, so that goes to the principal, and now you're paying interest on interest, which increases that interest. If you look at historical gold prices, you will see that the price of gold skyrocketed in the 2000s. In 2008, the price of gold ranged from around $720 per ounce to over $1,000 an ounce. As the economy sank further into recession, the price of gold rose to around $1,895 in 2011 due to investor confidence and demand. In April 2020, gold prices fell slightly from where they were nearly a decade ago, but continued to perform well amid an economic downturn. Many gold advocates suggest that this is a good hedge against rising prices. The facts, however, don't support this claim. Gold is often a better hedge against a financial crisis than a hedge against inflation. In times of crisis, gold prices tend to rise, but this is not necessarily the case in times of high inflation. If a financial crisis or recession is brewing, it may be a good idea to buy gold. However, if the economy is in a period of high inflation, it may make sense to switch.
Only gold is money. Everything else is credit. So JP Morgan, the bank today, needs to have their hands in all of that gold. Whether they're a trustee for the GLD and the other gold and silver ETFs, SLV, but they are the ones that have access to that. If you own a share of GLD or SLV, all you have are shares in a trust. And these things were designed to follow the spot market, which is so easy to manipulate. Never has it been more important than it is right now for you to have your strategy and plan, because those in power do. And those in power have the ability to hide a lot of things from you.
That's all for today. Let us know your views in the comment section below. And don't forget to like this video before leaving. Thanks for watching.